This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation.
Good afternoon. I am Janemarie Mulvey, and I'm going to talk to you briefly about the Affordable Care Act, Full Steam Ahead. A little bit about myself. I've actually authored a guide for small businesses, Health Reform, What Small Businesses Need to Know Now. And the information in that guide is also used to help with the American Institute of CPA's continuing education course for ACA. And I'm also an associate professor at UMUC. But today I want to talk mainly about what are the key elements in Affordable Care Act and how it will impact accountants. So ACA Full Steam Ahead, after much delay, ACA is fully implemented, and so we have premium tax credits for individuals and very small businesses. The so-called employer shared responsibility payments apply to all firms with 50 or more full-time equivalents in 2016 and beyond. There are new IRS reporting requirements that also apply to firms with 50 or more FTEs, and the fines for not filling out those new IRS reforms are going to be fully enforced going forward. And then the so-called individual penalties on uninsured individuals will increase substantially in coming years. So one of the questions I often am asked is, how does the ACA impact my firm? Well, it will depend on your firm size. And under ACA, firm size is dependent on something called full-time equivalents. So basically a firm will count all of their full-time employees, which is defined as if you work 30 hours or more a week, you're a full-time employee. And then you take all of your part-time employees and you prorate them up. You divide their hours by 120, and that will give you an FTE count. And as you can see from this chart here, for the very small firms, those with up to 24 FTEs are eligible for small business tax credits and the shop exchange. And they also are subject to much stricter insurance requirements. At the higher end, if you have 50 or more FTEs, these employers are potentially subject to employer penalties if their insurance does not meet certain requirements, or if they provide no insurance at all, and I'm going to talk about that in more detail. And they are also subject to these new IRS reporting requirements for all full-time workers. So I'm going to focus on these last two parts, the employer penalty and the new IRS reporting requirements. And what's interesting here is one of the reasons ACA is so complicated and it's important for CPAs to understand is it added over 2,600 pages to the tax code. So that's a lot more complexity to the tax code, and it's important for both CPAs and non-CPAs to understand what's in there. Potential employer penalties, one way to think about this is kind of in what I call 3 steps. So first you have to determine your firm size. Are you a so-called large employer and have 50 or more full-time equivalents over the past year? And if you are in that category, you won't necessarily pay a penalty. The penalty actually has to be triggered. So step 2 is the penalty is triggered if one of your full-time employees is eligible for the premium tax credit in the exchange. And once that happens, the amount of the penalty will depend on whether you provided health insurance or not. So let's go through these steps quickly. Step 1, firm size. So basically to measure your full-time equivalents, you figure out all of your full-time workers, those are those who are working 30 hours a week. You take your part-time employees and you prorate them, divide by 120 hours a month. And in this calculation, you only include seasonal workers who work more than 120 days. And you look at that number over the past year, and it's the average over the past year is if it's 50 or more, then you are a large employer. Now, in order for you to potentially pay a penalty, one of your full-time workers must become eligible for a premium tax credit in the exchange. And to do that, they have to have modified adjusted gross income under 400% of poverty. And as you can see from the chart on the right, that varies by whether you're in the contiguous states or Alaska or Hawaii. It also varies by family size. So a number you often hear is 400% of poverty is about $95,400 in the 48 states, contiguous states. And if your income is below that, your modified adjusted gross income, you could potentially be eligible for a premium tax credit. But other conditions must apply. Either your employer does not offer health insurance coverage, or the health insurance that the employer offers is not affordable, or it is inadequate. It doesn't have a certain minimum value. And I'm going to focus mainly on affordability because that is an area that employers may have trouble with. So the ACA defines affordability based on the employee's monthly premium contribution cannot exceed 9.66% of their monthly household modified adjusted gross income for self-only coverage in the lowest cost plan. That's a mouthful. The problem is employers do not know an employee's modified adjusted gross income or their household income. So IRS has issued 3 safe harbors that an employer can use to compare what their premiums are. They can use W-2 income, they can use their hourly rate of pay income multiplied by 130 hours, or the federal poverty level. And in any case, they can use that income to compare to their monthly premiums, and if their premiums exceed 9.66% of that, then they would be considered, the plan would be considered unaffordable, and they could potentially pay a penalty. So the amount of the penalty depends on 2 different things. If the employer does not offer insurance coverage to 95% of its full-time workers and their dependents, and that's key, dependent here is only children up to age 26, it's not spouse. Or they may offer coverage, but as I showed you a minute ago, it's unaffordable or it's inadequate. It doesn't meet minimum value. And just quickly, minimum value or inadequacy means that 60% of the cost of the benefits must be covered by the plan, 40% are out of pocket. In most cases, these plans are adequate. They just may not be affordable. So first, the penalty for not offering coverage to 95% of the full-time workers and their dependents. In 2016, it is $2,160 times your number of full-time workers minus 30. Now, the penalty actually is levied monthly, so you divide this number by 12, but simplified annual terms, this is the amount of the penalty you would pay in a year. However, it's very important to know that the employer will pay a penalty on all full-time workers who may be receiving coverage elsewhere. So if you have someone who has Medicare coverage, Medicaid coverage, coverage through their spouse, they will be in that full-time employee count, and then you minus 30. Now those employees can't trigger the penalty, but they are in the count. So the second penalty is if you do offer insurance and it's not affordable and it's inadequate, then the employer will pay the lesser of either $3,240 times number of full-time workers who receive a premium credit, or the number we just saw, $2,160 times full-time workers minus 30. Now, why is there a choice? Well, if you are an employer who has a large number of full-time workers who are low wage and the insurance will not be affordable to you, you may want to pay the $2,160 penalty times full-time workers minus 30. So an employer will have to do the math if they're in this situation. So in addition to the penalty, IRS basically is the gatekeeper to all these premium tax credits, to the employer penalty, to the individual penalty. And in order to figure out and administer these provisions, IRS needs to know who receives coverage, who provides coverage, and the characteristics of that coverage, including affordability. And to collect information on this information, IRS now has these new information returns, and I'm going to briefly tell you what they are. Keeping track of these new IRS returns can be very confusing, but it is helpful to think of them as the ABCs of information returns. And before I talk about the ABCs, I want to distinguish 2 key numbers. The 1095 forms are provided to each full-time worker or to each insured worker, and they are kind of like the W-2s. And then there are the 1094 forms, which are transmittal forms that insurers and employers provide to give IRS an indication of how the employer's characteristics are the insurer's characteristics. So now when you put an A or a B after those forms, all the A forms are the exchanges. The 1095A goes to workers in the IRS and even the unemployed to tell them that they have coverage through the exchange. They'll have to submit that to prove that they have coverage so they will not be subject to the penalties, the individual penalties. The B forms come from insurers and self-insured plans with less than 50 FTEs. So the 1095B goes to workers in the IRS, and the 1094B goes to the IRS. The C forms are what employers have to fill out. The 1095-C goes to all full-time workers in the IRS, and then the 1094 goes to the IRS as a transmittal. So if you just think of them that way, ABC, that might help it understand a little better. So one of the reasons that these forms have become administratively burdensome to employers is because they rely on monthly information. So on the employer side, they have to certify month by month that they offer coverage to 95% of their full-time workers. They have to put down monthly the number of full-time workers, and that's very important because remember we saw the formula earlier, and the formula is based on your number of full-time workers. They have to also put the number of all their workers, including part-time workers, and then they have to indicate their firm size in a given month. Now this could be tricky for some employers who change their firm size within the year, so they have to keep track of that. That's the employer level information on the 1094-C. Then for the full-time workers, they have to fill out the 1095-C form, and month by month they have to indicate the type of coverage provided to the employee, whether it was a spouse or dependent. They have to indicate the dollar value of the employee's premium contribution, what they did, because they're going to have to figure out affordability. And then they have to indicate these safe harbors I showed you earlier, whether they use W-2 income or some other measure to determine affordability. They also have to, if you have a new employee and you didn't work earlier in the year, you were not employed, you would use these indicator codes in that category. So we don't have time to go through the forms, but I just wanted to give you a general idea of the information on there. The due dates and fines for noncompliance are the following. First of all, it's 2016. You should have already filled out these forms this year if you had 50 or more full-time equivalents. In next year, 2017, for the 2016 tax year, by January 31st, you have to have the 1095-C forms to all of your full-time employees. By February 28th, you have to provide the forms to IRS if you have less than 250 employees. You have till the end of March if you're filing electronically and you have 250 or more employees. And the fines for noncompliance are substantial. It's up to $250 per statement, not to exceed $3 million. This year, in 2016, they were giving some relief for errors in the forms, but they weren't given relief if you didn't fill them out. Going forward next year, they're not indicating that they're going to give any relief for errors that may occur. And employers, if you see an error, you have to correct it as quickly as possible or you will be fined. So that is it in a nutshell. And if you have any questions, please email me at jm@mulveyhealth.com and I can try to answer your questions. Thank you.